On May 6, 2010, the Dow Jones Industrial Average did something no human trader thought possible. In less than 30 minutes, $1 trillion in market value vanished, leaving a chart that looks more like a cliff than a financial index. The investigation eventually traced the chaos back to Navinder Sarao. Working from his childhood bedroom, he used a spoofing algorithm to flood the market with fake sell orders, tricking the high-speed systems that dominate modern trading. This wasn't a sophisticated cyber attack from a nation-state. It was a single person using 16-year-old code to exploit the basic mechanics of how automated markets react to sudden shifts in supply and demand. The 2010 crash revealed that the more we automate our markets, the more sensitive they become to sudden, unintended signals. The fragility isn't a bug in the software, it's an inherent feature of high-speed execution. For decades, the public's mental image of the stock market was this: a loud, crowded room where human intuition, geopolitical news, and face-to-face negotiation set the price of a company's future. Today, those decisions are handled by hyper-intelligent AI. These systems analyze data and execute trades at speeds measured in millionths of a second, a pace that makes human cognition look stationary by comparison. The danger here isn't a Skynet scenario of malevolent AI. The risk is extreme efficiency. These systems are programmed to execute defensive moves instantly, without the capacity to wait for a human supervisor to weigh the broader consequences. While humans still write the code and set the initial goals, we cannot intervene at the speeds these programs now operate. During a major market event, we have effectively moved from being the pilots of the global economy to being its passengers. Modern liquidity in the S&P 500 is largely provided by black box algorithms. These programs are so complex that even their designers can struggle to predict how they will react to a specific, never-before-seen market anomaly. If one bot executes a defensive sell, it creates a data point every bot sees instantly. Trained similarly, they reach the same conclusion. Milliseconds later, competing bots mirror the sell-off. This triggers a stampede, a collective collapse across the entire grid. In a hyper-efficient market, there is no friction to slow the panic down. When every participant is optimized to exit early, the result is a massive and synchronized retreat. As trading moved off the floor and into the data center, risk management became highly centralized. Instead of thousands of individual traders making independent guesses, we now rely on a handful of massive AI systems. This is where Aladdin lives. It's BlackRock's proprietary risk management AI, and it oversees more than $20 trillion in global assets, providing the logic for some of the largest pension funds and banks on Earth. Having so much of the world's wealth governed by a single monolithic algorithmic logic creates a structural bottleneck. If that logic identifies a systemic risk, every portfolio it touches may try to move through the same narrow exit at the same time. If Aladdin's models indicate that the only mathematically sound move is to liquidate, there is no countervailing human logic big enough to stop the resulting sell-off. Relying on a single dominant risk assessment logic means that when a mistake finally occurs, it won't be local. It will be shared by every institution using the same software. In the past, market collapses had a human face and a public warning. You could see the lines outside the banks and read the headlines on the tickers as the crisis developed over days or weeks. The next major market event will likely happen within the digital architecture, occurring far faster than a news can report it. By the time a human trader sees the red on their monitor, the machines will have already finished their move. The cascade will move through the fiber optic cables at the speed of light. Before a circuit breaker can even be considered by a human regulator, trillions of dollars could change hands or vanish entirely. When execution speeds are measured in nanoseconds, the time required for a person to recognize and stop a feedback loop simply doesn't exist. The architecture is built for speed, not for human speed intervention. For the independent trader, the goal isn't to try and fix a broken system. The objective is to recognize the patterns of machine panic and prepare for the resulting price swings. When centralized algorithms stampede, they often create massive short-term pricing anomalies. They are forced to sell assets at any price to satisfy their internal risk parameters, regardless of the company's actual value. These moments of extreme machine-driven volatility facilitate a rapid transfer of wealth. Those who understand the code behind the crash can find opportunities that didn't exist when the market was calm. The next digital stampede is a matter of when, not if. When the screens go red, are you watching the traditional charts or are you watching the underlying code?